Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we are going to talk about the second part of your 7th chapter, that is provisions and reserve. In the first part we discussed all about depreciation, right? Now before I go into the literal meaning of provisions and reserve, let me just start with a simple example, right? Now your parents are earning an income, right? Now after they are incurring certain expenses for the full year. Now after incurring certain expenses, they are left with certain savings. Okay, now let's say somebody asked some kind of a favor for them and asked for a certain amount of money, and they said that yes, we will pay you back after a point of time. Out of generosity they helped that person, but they know that person, it may be their friend, relative, or anybody, right? They know that person will not pay, okay, or maybe pay partial amount, right? So they can't consider like the whole savings that they are having as their income. Okay, they can't consider like whatever they are going to, that person is going to pay me the full amount. So what they will say, okay, I can't consider the whole saving as a part of my spendings or whatever. I have to take out this particular portion, right? And now I am left with certain amount of savings. Now that savings, they will keep those savings for certain specific purposes, right? Like for your future education, like say every year you go for holidays, so they won't consider, okay, let me take out 20% of my savings, let me keep it for the holidays, let me keep the 10% for the entertainment purpose that we do next year, let me keep a certain purpose for my child's education, future education, so that all of a sudden when you enter or when you join a new field, they ask for a lot of money, or you go to certain tuition classes, they ask for money, so all of a sudden that liability or that burden doesn't come on them, so they keep a certain portion out of it. So the first part wherein I said they give amount to somebody and they know that somebody is not going to pay to them, they keep a provision for it. Okay, they may pay, they may not pay, so they keep a provision. Okay, this person is not going to pay to me, that amount is I'm not going to consider it. Okay, and whatever is left, what they do, they appropriated it for certain specific purposes. When they appropriated it for a certain specific purpose, what is it? It is a reserve. That's all. Okay, now it's not that's all, there are certain terminologies which I know is very difficult for you to understand at this point of time, because these terminologies you are going to get to know about it in the future, in your 12th standard, in your colleges, the whole chapter will be related to it. But there are those terminologies which are just blowing your mind, right? Okay, now let's start with first provision. As I said, that provision is what? It is a charge against the profit. The organization has earned an income, they have incurred certain expenses. What is left with them? Profit. Okay, now those profit, out of those, or they can't consider the whole profit as their current year's profit. There are certain actual expenses about, they don't know the actual amount what of that particular expenses, so they need to create a provision for it. Why? Because as we studied in our second chapter of wherein we considered the accounting concept, we studied about prudence, the concept of prudence, okay, conservatism. So they are going to keep certain amount for that contingencies, for that expenses which are current year's expenses, okay, but they don't know the actual amount or the actual liability, right? Now what are those provisions? The first could be the provision for depreciation. What is provision for depreciation? We already studied, so let's not waste time in this particular video. Second is provision for bad and doubtful debts. Now what are bad and doubtful debts? We studied about debtors, right? What are debtors? Debtors are somebody to whom the organization is selling the goods on credit, okay, and the debtors will pay them that amount after a point of time. Okay, now there could be three kind of debtors. One is good, one is bad, and one is doubtful. Okay, When I say good debtors, what do you mean by good debtors? Good debtors means who are, very diligent, who will pay off the money. Okay, they have purchased goods on credit, they will pay you the money. What are bad debtors? That relative who don't pay. Okay, that person, that friend of yours who don't pay. Okay, so bad debtors means you have sold the goods to that person and you know that person is not going to pay. You consider them as bad debts. Okay, there is a, it. Okay, there is a surety that debts are not going to paid off. And there are doubtful debts. Doubtful debts means what? They may pay, they may not pay. Okay, let's take an example. Let's say there are total 50,000 as your debtors, right? Now out of 50,000, you know that 5,000 are my bad debts. You get to know these are 5,000, so you have to deduct, like 5,000 amount is something which I am not going to receive. So what you are left with? 45,000, right? This is the amount, and you know that there are chances that 10%, let's say 10% are doubtful. There are certain debtors, 10% of the debtors who are doubtful. You are not sure whether they are going to pay you the money or not. So you create a provision for bad and doubtful debts. 10% of 45,000 is 4,500. So you are left with 40,500. Okay, this is what you are going to show in your books, that these are the debtors, these are the persons who are going to pay me, right? So good debts, bad debts. Bad debts, we don't create a provision. Bad debts, we know that these debts are not going to pay off to me, and then we create a provision for bad and doubtful debts. Those may not pay. Okay, so that 10% are not going to pay to me, so you create a provision for them. Out of the profit, the whatever profit is you are left with, you create a provision for it. Okay, next is provision for discount on debtors. Provision for discount on debtors means what? Let's say you sold the goods. Okay, when you sold the goods to the people, you said to them that if you pay to me within 30 days, I am going to give you a discount of 5% of your total amount. Okay, let's say you sold 10,000 worth of goods, you say 5% discount I will give, so it's 500. Okay, now if they pay you in time, you have to give them a discount. If they don't pay you, you will charge the full amount, right? So you need to create a provision for that particular purpose also, that they may pay your amount in time. Okay, when they are going to pay you in time, you have to give them discount. That discount is the current year's expense. Okay, it's not the next year, it's the current financial year expense, but you are not sure about it, so you need to create a provision for that also. So that is a provision for discount on debtors. The next is provision for taxation. Provision for taxation, obviously you have earned profit, you have to give money to the government as a form of taxes. Okay, now when we calculate tax as per accounts, it's different, and when the tax is calculated by income tax law, it's different. So that income tax liability will come on its due date. Okay, now it will come on the due date. You have to pay the taxes. It's not like you can't pay, you have to pay the taxes, but that liability has not yet occurred. Okay, so what you need to do, you need to create a provision for that. Okay, that tax, there is a liability that you have to pay the taxes to the government, but still that has not become due. Okay, but it is of current year's expense, you have to provide for taxation. So that is provision for taxation. And the last is provision for repairs and renewals. I know there are certain work, there is certain work at my home or in the business wherein I know that this thing is getting damaged, I need to get it renewed or I need to get it repaired, but I don't know how much amount they will charge me. So you create a provision for that also. So this is the liability, this is current year expense which you know, but you don't know the actual amount. Okay, what you need to do, you need to reduce that amount of profit from your books. Okay, so why you need to do it? So as to give you a true and fair view of the financial position, right? Like these are the expenses which are going to occur. You can't show the profit at such an exaggerated amount. Okay, you need to provide for all these expenses. Now let's talk about reserves. Likewise, I said earlier also, like when your parents you are left with the savings, they need to appropriate that savings for certain specific purposes. Okay, what is that? That is appropriation of profit. That is not an expense. Okay, after the profit, after like deduct expenses from the income, you are left with profit, you provided for certain expenses. After that, it is your own money. Okay, it's company's own profit they are left with, that is their money. But they know that in future they need certain amount, okay, for certain specific purpose. Okay, so they need to keep for fun, for that contingency. All of a sudden, if certain things happen, their profit will reduce drastically, or they will be burdened with something. So to avoid that, what they need, they keep a certain amount of reserves for certain specific purposes. Like your family keeps it, your parents keep it for your education, for the holiday expenses, for the entertainment purposes. They keep a certain reserve, and now they say, okay, this is the amount like I'm left with, and I can use it for other purposes. Okay, so this is what reserves is what? Appropriation of profit. Okay, now these reserves have been divided into two. One is a general reserve and one are specific reserve. When I say general reserve means you can use it for any purpose. Okay, you keep a certain amount. Okay, this is the amount I have kept. Any certain things happen in the organization, I use that much amount of money. But there are certain specific reserves which you have to keep it. Okay, what are those specific reserves? One is dividend equalization reserve. Now what you will be like, what is dividend, right? Now let me say you in a company, what a company do, company needs money. Okay, what they do, they ask money from the public. Okay, how they ask money from the public? In the form of shares and debentures. Shares and debentures. Okay, they issue shares or debentures and they ask for money, and the people, the general public, will give them money and they will get the shares and debentures. Okay, now when they are issuing shares, what is a share? Share means you become the owner of that particular company. Okay, debentures is kind of a liability. When you become the owner, like whenever a business is running, whatever profit or loss that the owner has to incur. Okay, so when you are giving money in the form of shares to that particular company, if the company is running into losses, you are not going to get that money. Okay, but if the company is running in profit, when they will get the money? At the end, like when the company winds up, close its business, then only the shareholder will get their money, right? Now, but what are debentures? Debentures are kind of a liability which the company has to pay them. Okay, they say that after a period of, let's say, 5 years or after a period of 10 years, we will pay you off the money. So debentures are kind of a loan for the company which they have to pay it off. Okay, now when, like, if you are investing, if you are putting certain amount in the bank, what the bank give you? Interest. Okay, similarly, when the people, general public, is investing their amount, investing their money in the company also give them a certain amount of interest. Okay, in case of shares, it is called dividend. Okay, it's called dividend, and in case of debentures, it is called interest. Dividend, sorry, it's D. Dividend, the company may pay, may not pay. If they are having a profit, they will pay it. If they are not, they are running into losses, they will not pay. Interest, they have to pay to their debenture holders, right? Now when I say dividend equalization reserve, let's say the company said that every year we will pay you 5% dividend if we are having a profit, right? Now the company pays 5% of the profit every year. In a particular year their business grows massively, they incurred a good amount of profit, right? Now at that time what the company will do, they will retain that profit. Okay, retain the profit, so as in future if there is not that much amount of profit, they can use that amount and give it in the form of dividend to their shareholders, right? So when they retain that profit, where they will keep it? In the dividend equalization reserve. They create a specific reserve for their shareholders, right? So that when in case there are no such profit, from that reserve they will pay dividend to their shareholders. Okay, so this is a specific reserve for their shareholders, right? Second is workman compensation fund. Now when I say workman compensation fund, there are workers working in the organization. Okay, now some accidents may happen, certain unforeseen circumstances may happen, and they have to pay. Accident happen, they have to pay for the hospitalization, medical expenses, or fire broke out, something happened to their workers, they need to pay that amount to their workers. Okay, so they know that they obviously don't want those things to happen, but if at all it happens, they need to keep a certain amount in the form of workman compensation fund. Okay, so that is a specific reserve for the workers. Next is investment fluctuation fund. Investment, obviously the organization is also investing in certain other things, okay, and the market is fluctuating too much, sometimes it's too high, sometimes it's too low. So to maintain the stability, they create an investment fluctuation fund. When it is too low, they need to transfer to their investment so that their books doesn't show that much of fluctuation, right? So for that they create an investment fluctuation fund. And the next is debenture redemption reserve. Debentures, okay, debenture holders, they need to pay money to their debentures holders, so they need to create, like when they give debentures, it is called issue of shares and debentures. When they issue the shares, they give the shares and debentures, and when they pay off the money, they redeem them. Okay, they redeem the debentures. So it is when they redeem them, they need to pay money. So from the date when they took the money from their debenture holders, they keep a certain proportion of their profit in the debenture redemption reserve, so that at the end when they have to pay, they have that particular amount in their reserve, right? Now all these reserves, from where they will take out? From the profit, right? Now that profit could be a revenue profit and a capital profit. You have learned about revenue expenditure, capital expenditure, and all these things. Now revenue profit means what? General operation of the business. The business is doing certain activities, from that business activities, from there they are operating that business, from that whatever profit is earned is called as a revenue profit, right? They are into the business of buying or selling the goods. That particular business, they are, from their operational activities, they are earning a profit, that is known as a revenue profit. And out of those revenue profit, they keep a certain portion as a reserve. Okay, what they keep? In the form of what? General reserve, which we already discussed. Okay, this reserve, this profit is available for dividend also, right? Dividend also means they can give dividend from that profit, because the profit belongs to the shareholders, so some portion they give to their dividends. Okay, so there is a general reserve, dividend equalization reserve, these all things which we discussed: dividend equalization reserve, workman compensation fund, investment fluctuation fund, and debenture redemption reserve. These are the reserve that they create out of the revenue profit. Okay, now what is capital profit? Okay, which doesn't relate to the operational activities of the business. Okay, it's not the operational activities which the business is carrying out, it's certain from other things is considered as a capital profit, and that capital profit, we have to transfer it to capital reserve. Now what could be those capital profit? You will be like, okay, like what other business they will carry for? A business is formed to carry out its certain activity. What could be the other things, right? First is premium on issue of shares or debentures. Now what is premium? I know when they are issuing, there are guidelines by SEBI, okay, Security and Exchange Board of India. There is a board which regulates all these things. Okay, now as per them, they have to compliance with them. Okay, now they are issuing shares or debentures, they have a certain value. Okay, the value which is written on those shares or debentures, the value written on those shares or debentures is called the face value. Okay, that is the value the company is charge you from you. Okay, in the form of shares or debentures, you will get a share of debentures of that particular amount. Let's say it's 10 rupees. Okay, 10 rupees is the face value of shares. Okay, now the company is earning good profit and you want to invest in that company. Okay, so what the company do? The company issue the shares at a higher amount. This is the face value, right? They issue the shares at a higher amount, let's say 12 rupees. So this 2 rupees at a higher price from the face value is known as premium amount. Okay, this is not a general operating activities that a business is carrying out, but the organization, its name is good, people are ready to pay the money, and so what the business do, they charge an extra amount. Addition to that, the face value, they can issue the shares at premium or at discount. Discount means at a less value or at a premium value. So the additional amount which they get out of the face value is known as premium. So that premium is not the general operating activities of the business, that is considered as a capital profit. So premium on issue of shares, these are the examples of capital profit, right? Capital reserves, I will tell you, but these are the examples of capital profit. They need to use it for certain specific purpose only, and they need to show it in their books as a capital profit. So premium on issue of shares or debentures is capital profit. Next is profit on sale of fixed asset. Like in the last chapter you just studied that whatever profit or loss on sale of fixed assets, we transfer it to profit and loss account, right? Now, what is this profit? Why capital profit? It is considered as a capital profit. Now, let me explain you. Let's say you purchased a machinery worth rupees 1 lakh. Okay, you provided depreciation for 2 years. Let's say first year 20,000, next year again 20,000. So your book value is 60,000 at the end of third year. Okay, this is the book value at the end of third year, 60,000, right? Now let's say now you don't need that machinery. Okay, you want to sell that machinery. What happened when you went to the market? You got an amount of 1,20,000. What is the book value? 60,000. What you got? 1,20,000. So over and above the purchase price of that particular asset, what was your purchase price? The original cost 1 lakh, and this is what? 1,20,000. So this 20,000 is known as capital profit, whereas 1 lakh minus 60,000, that is 40,000, is considered as your revenue profit. Okay, 40,000 total profit. How much you earn? 120 is the price that you got, 60,000 is the book value. You got actual profit of 60,000, right? But this 60,000 is divided into two. Over and above the purchase price is considered as a capital profit, and then remaining is considered as a revenue profit. So profit on sale of fixed assets, right? This is a capital profit. Next is profit on redemption of debentures. We studied issue of debentures, redemption of debentures. Redemption means when you pay off the money. Okay, now the company can purchase its own debentures from the market, right? Now when they are purchasing the debentures from the market, they are paying a less price as compared to the face value. Okay, let's say they are having a good repo, the debenture value of was 100 rupees, they purchase the debentures at 80 rupees. Okay, so they are paying 80 rupees when they are redeeming the debentures. They are purchasing their own debentures and giving off the money to the debenture holders at a less price. So this 20 rupees is considered as a profit on redemption of debentures when you redeem the debentures, right? Next is profit on revaluation of fixed assets and liabilities. Revaluation means after, let's take this example. We were taking in our books, we purchased at 1 lakh, we were charging depreciation, our book value was 60,000. But when we revalued our assets, we got to know, oh, this machinery's value in the market is 1,20,000. We have not sold it. Okay, we are not selling it, but we are revaluing our books, okay, at the price which is actually there in the market. So when we revalued, what its price come? 1,20,000. So my machinery is showing at such a low amount. So I need to revalue it. Okay, I need to increase that amount. You are not actually earning a profit. So when you increase the amount of your machinery, the remaining, like, that is considered as the capital profit, and you need to show it as a revaluation of fixed assets and liabilities. So that is a profit. You have not actually earned, but you need to transfer it into the revaluation reserve. Okay, revaluation reserve, you need to create it. Okay, next is profit prior to incorporation. Incorporation, the business started, before that business starts, after that the business carry out its activities, then only business will earn its income, right? They will gain profit or incur losses. Before that, how they can do it? Let's say a company take over another business. Okay, now that business they took over on 1st of Jan, but it takes time to get registered. When they get that registration certificate, then only they can show it in their books as their, they can carry out the operation. But the business which they took over was going on, let's say they took over on 1st of Jan, but it started after, it incorporated after 1st of April. So the 3 months profit that business earned is considered as a capital profit, because that is, business has not yet commenced, it is not incorporated. Okay, it is not registered. So before that, the profit earned is considered as a capital profit. And the last is profit on reissue of forfeited shares. Again a new term, right? Forfeited shares. What are forfeited shares? Let's say the company issues shares. Okay, they ask for money in installment. Okay, give me first in this month, when you are applying for shares, give it 3 rupees. Let's say 10 rupees only. Okay, 10 rupees is the face value. They are asking for money. They say, let's give me 3 rupees. Then I will allot. Then give me 2 rupees. Then I will take a final call and give me the remaining 5 rupees. Let's say. Okay. Now when they are asking money from the public, there is a one shareholder who pay 3 rupees. Okay, while applying for those shares. Then the shares was allotted to them. When it got allotted, they asked for 2 more rupees. He paid 2 more rupees. Then for the final amount, they say, now pay us 5 rupees. 5 is remaining out of 10. 5 is paid. 5 is remaining. Now that person didn't pay this 5 rupees. Okay, they took a final call. What they did? Let's cancel his shares. Okay, that is forfeited, they forfeited his shares. Okay, now there are, like, what they will do now, they are having those shares, they will reissue those shares. Okay, now they can maximum give a discount. They have already collected 5 rupees, so they can maximum give a discount of 5 rupees to the next shareholder. Okay, let's say they are issuing that shares at a discount of rupees 8, right? 2 rupees is the discount they are giving. Maximum discount they can give 5 rupees per share, but they are giving a discount of 2 rupees and issuing it for 8 rupees. So 3 rupees is what they earned a profit on that forfeited shares which they forfeited it. They were having 5 rupees of that particular shares, and what they did to the next shareholder, they issue it at 8 rupees. Maximum discount they can give 5. They give a 2 rupee discount. So the 3 rupees is considered as profit on reissue of forfeited shares. Okay, so these are the examples of capital profit, okay, which does not relate to the operational activities of the business. So for this is a capital profit, and these capital profit can be used for certain purpose only. What are those purpose? To write off capital losses or issue of bonus shares. For this purpose only this profit will be utilized. Okay, what is issue of bonus shares? I know shares, debentures, issue, redemption, dividend, interest, I know, but I want you to understand these terminologies. Okay, then only you will be clear with this particular topic, provisions and reserves. Right now, what is issue of bonus shares? Bonus shares, bonus, as you see the term, something which we get over and above certain thing, right? Bonus shares to the current shareholders. They are having a reserve to the current shareholders. They decided to give extra shares without charging any money. When they issue shares, they charge money, right? They ask for money. But when they issue bonus shares, they are giving an additional share to their shareholder without asking for money. So from where they will take out that amount? From their capital profit, from the capital reserves they have kept for the business, for the organization, whatever capital reserves they have, from that capital reserve only they can issue the bonus shares. Okay, understood? What is provision? What is reserve? General reserve, for any purpose they can use. Specific reserve, for specific purpose they have to keep those reserves, right? Those reserves can be categorized into two. There is revenue reserve and there are capital reserve. Revenue reserve means which you take out from the revenue profit. Capital reserves means which is there available for you from the capital profit. Okay, revenue reserves can be used for these purposes. It is not available to give dividend. Okay, whereas the capital reserves are for certain specific purpose, wherein you can give as a, you can write off your capital losses, or else you can issue the bonus shares. Okay, now you will be like, then what is the difference? You will be asked maybe what is the difference between provisions and reserve. So let's discuss. Right now, when I say provision, first thing, whenever you are asked the difference, first thing you have to keep in mind what it is. Okay, what is a provision, what is a reserve? Provision means something which you have charged against the profit. Okay, you have a profit, you have charged against it, that is called as a provision. Reserves is an appropriation of profit. You are left with the profit, you appropriate for that profit for certain specific purpose. Why there is a need to do it? Because there is certain expense. Okay, current year expense, they are current year expense, but you know the actual amount and it is required, so need to keep the provision. Whereas reserves, it is not required. Why there is a, what is the purpose to keep the reserves? So that it strengthens the financial position. Whenever any unforeseen circumstances happen, you have that particular reserve and you can use that particular reserve. Wherein in profit you can't provision you can't show it as an exaggerated amount. You have to show the true and fair profit value. Here you have to strengthen the financial position of the business, right? Now you will be say like whether it is required provisions or reserves. Yes, provisions are required. Okay, you need to keep the provisions for the business. Okay, these are actual expenses. It's just that you don't know the actual amount, right? Whereas reserves, it is completely optional. Okay, it's not necessary you keep a reserve, but the company keeps it for its own purpose. Okay, now tax benefit. Obviously, when a business is running an organization, they will be like, am I going to get any sort of tax benefit? Provision? Yes. Why? Because it reduces your taxable profit. You income, deduct the expenses, profit, keep provisions for all the things. What is remaining is the profit before tax, and that taxable amount you will be charged. Okay, so it reduces your taxable profit, whereas this doesn't have any effect on your taxable profit. Okay, it's after everything you are keeping it. Now how to show it, where to show it in the books? There are certain provision, likewise we discussed in our previous, like provision for depreciation, or when we say provision for bad and doubtful debts, provision for discount on debtors. Where you need to keep it, there are two columns, assets and liabilities. For assets, as we discussed, we can reduce that amount. For provision for depreciation, we can show the assets at a reduced amount. Similarly, debtors also, we show it at a reduced amount, or else you can show it on the liability side. Okay, after capital amount, there is another place wherein you need to show the provisions and reserves. So reserves, you can show it as in you have to show it in provisions and reserves after your capital amount, right? So this is how you will show it in your books. Now the last thing what is remaining is this available for dividend? Provision amount, like whatever profit is remaining, you can't give it as a dividend. Okay, this is not available. After calculating provisions, only the amount left is something which you can give it as a dividend to the shareholders, not before that. So even if you are incurring losses, you have to provide for all these things. Okay, but if you are incurring and earning an income after providing, whatever left is something you can give it as a dividend, whereas in this case, yes, you can give as a dividend to your shareholder. So this is how you will show the difference between the provisions and reserves. Okay, now I hope you understood all things. There's one more terminology, and that is secret reserves. Okay, so there is a term called secret reserves. What is secret reserve? Secret reserves, why it is called a secret reserve? Because we don't show those secret reserves in a book. We try to manipulate our books in such a way that we create a reserve for it. How to manipulate? Let's say the investments. Okay, we are showing like inventories. Let's say our stock. You will read this. Whenever we are showing the stocks in our book, we can show our stock or inventories at book value or market price, whichever is lower. So you can manipulate it, because you can show it at a less rate. You can say that, okay, like my cost is less, so I will show it at a less value. Similarly, there are certain liabilities which may happen, which may not happen. That is known as contingent liabilities. But what you will show in your books as an actual liability. So actual liability, you will reduce your profits, right? Reduce your profit. That is a kind of a reserve. Now the general public won't be knowing that this is a way, there is certain reserve being created, but in such way you can create those reserves. Okay, so that is known as secret reserves. I hope you got both these terminologies, provisions and reserves. I hope you understood all the terms which I tried to explain you, and I wish that you are clear with all these things. Thank you very much.